also the risks to the European economy. And so perhaps as an opening, I just want to give you the floor to kick us off with a few remarks on where do you see the main risks, where do you see the opportunities perhaps also, and how do we address them? And then we want to engage in a conversation. And of course, we do have some time also for questions from the audience. I think there will be microphones handed around. But of course, for those of you who follow us online, you can please also join us and ask questions online on Slido with the code BAM Global, BAM Global, and then I can see some of those questions and read them to the managing director. So without much further ado, thank you so much, Kristalina, and we look forward to your opening remarks.
Thank you very much, Guntram. I cannot tell you how much I regret not being in the chair next to you. I feel nostalgic for Brussels, but technology allows me to attend, so that's fantastic. And Jaromír, great to see you. We miss you. Guntram, I can tell you that my appearance today is a message of forgiveness to you for stealing Jaromír from us. Let me start by confirming what you said in the very beginning. This is a very difficult year, and the next one very likely would be even harder. So where are we as a world? On the economic front, we have been hit by one crisis on top of another, and we may be on the way of a self-made third crisis, and I'll come to that point. In 2021, towards the end of the year, we were pretty optimistic. We thought that with the arrival of vaccines, we would put the pandemic in the rearview mirror, and that there would be a rapid recovery continuing in 2022. It feels like a long time ago, but we did finish 21 with 6.1% global growth. Unfortunately, since then, three things happened. The first one is that Omicron proved us wrong, that the pandemic was not over. Secondly, we got the incredible return of war through the Russian invasion of Ukraine on the territory of Europe, with bombs and killings happening again, refugees leaving their homes again on a very massive scale. And we have seen that a double whammy of prices being pushed by supply side interruptions from the pandemic are exacerbated by supply side interruptions and commodity price increases due to the war and its consequences, making inflation top of mind issue practically everywhere. So when we look at 2022, we have already downgraded 3 times our projections for global growth, and the news coming from second quarter, as well as what we anticipate in third, fourth quarter, is not good news. Second quarter data tells us that the world economy shrank by 2% in that quarter on a quarter-to-quarter basis. And the data that we look at now, like where we see the orders for in industrial production, or what are the sentiments that we are following, they all tell us that we should brace for a tough end of the year. China slowing down, the US slowing down, Russia in recession, although it may be not as deep as we thought in the beginning, and Europe, you know that very well, finding itself in a very tough spot, with the most troubling sign for us being every time we do a projection, we have a downside scenario, and every next time it is materializing. Now, today, we are yet not to see what exactly we would be projecting in October, but for sure, we have a 22 that has caused tremendous anxieties. Now, looking into the next year, inflation would be still with us. And what it means is that monetary policy will have to continue to tighten. Tightening means interest rates up, but also it means in terms of sequencing with the US Fed being ahead of other major central banks, the dollar is appreciating. You see it in Europe. It is a mixed blessing. For tourism, it was a good development, but overall, it is a troubling sign. And if you are in an emerging market economy, this combination of high interest rates and dollar appreciation for countries with high level of dollar denominated debt is incredibly problematic. That takes me to something that Jaromír has been fantastic in leading at the fund. What is happening on the debt front? We have today 25% of emerging markets in or near debt distress, over 60% of low-income countries. And on top of this, we have seen this year that the climate crisis is very real. The climate shock has contributed to making 2022, and it will be contributing to making 2023 a very difficult year. So what does that mean from a policy perspective? First, it means that fighting inflation, overwhelming priority everywhere. Why? When we look at the projections for this year, advanced economies nearing 7% inflation, emerging markets, developing economies 10 or more. In that environment, the risk of inflation taking a course on its own that would be devastating for people and economies has gone up. So monetary policy priority to bring inflation under control. And that is not easy when the economy has been slowing down. It takes courage and determination and of course independence of central banks to do what they have to. Otherwise, we are hurting everybody, but we are particularly hurting the poorest people. Inflation is a tax on the poor. Fiscal policy, well, it has to provide cushion for the most vulnerable people. The risk always is that there would be pressure to do more for everybody, and that pressure needs to be resisted. Why? Because otherwise, if we are going on a very generous path of support, which the populations in many countries are demanding and putting pressure on politicians, then fiscal policy becomes the enemy of monetary policy. It actually makes the fight against inflation much more difficult. For countries where there is fiscal space, doing targeted support is easy. Where there is no fiscal space, it is incredibly difficult because the only way fiscal policy can act is by reprioritizing spending. I'm in parentheses, I'm in at the Netherlands. I was meeting with heads of states from Africa yesterday, and I was very encouraged to hear a mature approach from Senegal, from Ghana, from DRC. Slow down investments or even stop longer-term investments so you can actually do the right thing for the vulnerable people. And the third point I want to make, and that was where I indicated I would come to later, is, and we have to do all this in a very troubling global environment where the invasion of Ukraine has generated geopolitical tensions and where fragmentation is becoming a very, very real risk. So we have to work together at a time when this is more difficult than before. And perhaps I will pass now the floor back to you, but perhaps we can talk more about what is going on and how we need to operate, especially international institutions, in this brand new environment of tectonic plates shifting.
Yeah, thank you so much for these opening remarks. Very clear, and I have to say also quite pessimistic in many respects. And I would say also what I took away is that you had quite a hawkish tone on a number of the central issue, and in particular on the question of monetary policy at this stage. And I also noted that you started off by mentioning Omicron and the pandemic, which I mean, if you were now sitting next to us here in the room, you would notice that nobody in the room actually wears masks. So the people feel the pandemic is over, but of course we need to remember it is not over, and it may return with a vengeance, with new variants, etc., with additional risks to the global economy. Perhaps before we go to the fragmentation point, I mean, just one point to push you a bit on your inflation message. I mean, it's obvious that inflation is driven by a combination of factors. One important factor is the energy crisis. Here in Europe, energy prices are roughly 10 times as high as they used to be only a year ago, and that drives a significant part of the inflation. But the other factor really driving inflation is global fragmentation or tensions in the geopolitical system. And so in a sense, I guess what I would love to hear from you is, as we have these two factors driving inflation, is a very strong monetary response. Is that really the best recipe? I mean, it's a huge negative supply shock in many respects, and you know, what else can we think of? And will this price shock not in some respects disappear? This inflationary shock disappear as the conditions on energy markets hopefully improve at some stage?
This is a very, very fair point. And obviously, when I was talking about the role of monetary policy at the time when inflation is stubborn, I am not going to the details of what is causing inflation. So let me be more specific. We have part of the inflationary pressures coming from supply side disruptions. And we were hoping, remember, end of last year, that these disruptions would disappear and inflation would be transitory. But what we found out is that they are not disappearing, and that the buildup of inflationary pressures is such that monetary policy cannot continue to be passive, to be complacent. Why? Because we have to recognize interest rates were in many places in negative territory. Even with a more hawkish approach that has been taken by central banks, by and large, we are still catching up to bring inflation down but most importantly, to bring interest rates into a neutral territory or positive, even more so into positive territory. If you look at actions taken so far, emerging markets were earlier to recognize the threat of inflation. Countries like Brazil have taken action early, and as a result, emerging markets, some, not all, some emerging markets are ahead of the curve in bringing inflation under control. So there is an issue around inflationary pressures that central banks cannot avoid. But then we get into disaggregating what is driving inflation. And I completely agree with you that one of the drivers is fragmentation. It is the fact that we are now saying, well, cost, not the only determinant of where production should take place. Security of supplies is important, and maybe for some product lines more important than cost. This is a change in philosophy that, of course, has implications on the level of cost for production globally, and therefore it is unleashing an increase in prices that is going to be sustained over time. And their central bank policies, of course, is not going to make a difference. We also have to recognize that the geopolitical tensions may open up some sourcing from low-cost destinations that have not been taking an active role, like Africa. Should that happen, then we may see a counterbalance of that pressure on prices, but we don't yet know. There is a huge uncertainty as to how the economy is going to shape up now that the tectonic plates are indeed moving. So my basic message is bringing interest rates to neutral, moving into positive territory. This is not quite yet done. And monetary policy cannot ignore that if it is not done, that could have a acceleration impact on inflation. And on the other side, we do have to be very careful on a country-by-country basis to identify what is the right policy, because as your question indicates, if central banks overdo it and then step on the brakes of the world economy, then we might find ourselves in a very tough spot in 23.
Yeah, thank you very much. And I think fair enough, the point on the neutral rate is, I think, very clear and well taken. So let's talk a bit about the fragmentation point more specifically. And you mentioned, of course, that that leads to increases in costs because of supply chains being rethought out of security concerns. And you also did mention the war in Ukraine, which, as a result of the sanctions and the various tensions, meant that apparently around 1,000 companies left Russia, as documented in a recent study by Yale University. So we see these companies really reacting and having to react to these geopolitical tensions. But the question that is now being asked is, of course, but what if the geopolitical confrontation goes beyond Russia and looks at and we are looking into a big country like China, and of course that question is a difficult one. At the same time, it is a question that I think is quite has to be asked at the moment in a situation where China has at least endorsed Russia's war against Ukraine. So So I guess my question is to you, China remains an important partner, remains an important trading partner, but there are some risks. How do we deal with these risks, and what recommendation would you also give to companies as regards this very specific but quite big risk?
Let me start by saying, stating the obvious, that we have benefited all tremendously from global cooperation and the integration of the world economy. Everywhere, everybody is better off because of that. So, recognizing that globalization did not work equally for everyone, recognizing that globalization did leave some behind, and that we were slow on the uptake of identifying policies that can remedy this very serious problem, we still know that fragmentation is going to lead to the world being poorer. And I will come to the economic data that tells us what we should expect. So when we look at the geopolitical tensions today, we have to separate two issues. One is a horrendous abuse of what is the international order. Invading another country brutally clearly should be condemned, and this is what the world did in a quite unanimous way at the beginning of the invasion. From economic competition and the importance of countries looking at this economic competition from the perspective of what is best for their people, for their businesses. If you separate these two topics, it is clear that what is in the interest broadly of businesses and people is to have open trade, technological cooperation, global standards, and payment systems that integrate the world economy. What is the cost of not doing it? Well, the cost is a fairly significant reduction of the size of the world economy because we forego the advantages of integration that we have enjoyed for so many years. I mean, I just want to place the numbers that are so staggering. Over the last 3 decades, we have seen a quadrupling of the world economy in emerging markets. It has increased 3 times. For advanced economies, it doubled. For emerging markets, it has quadrupled. What does that mean? It means 1.3 billion people lifted out of poverty. So we're not talking about some minor issue. Whether we can sustain the economic and then social benefits of cooperation is quite a fundamental factor for the well-being of our children, for the well-being of people around the world. Now, when companies are saying, should we go to China, should we not go to China, of course they have to take into account multiple considerations. I'm not going to give them advice. It is for them to decide. What I would only say is that the Chinese economy is sizable. Its functioning has been broadly an element of this engine of growth that has led to these benefits globally. And it continues to be a potential factor for stability by growing and integrating within the region and with the rest of the world. Obviously, we have to all be making a very strong assumption that this is done on the platform of respecting international order and respecting national sovereignty. Yeah. If that is being disrupted, that would cause a tremendous change in outlook for global cooperation. From where I sit, you asked me how we operate. We have 190 members. We work to bring those members together because a coordination of economic policy makes everybody better off. We saw it in the first weeks of the pandemic. The fact that we were able to bring ministers of finance and central bank governors quite immediately led to a synchronized policy response that was completely non-orthodox. Central banks and finance authorities taking steps to ease the burden on people and put a cushion under the world economy. It worked. We remember, Gurdner, we were projecting at the beginning of the pandemic that there would be 10% contraction. Basically, that means depression. What did we have? It was bad, 3.1, minus 3.1, but way less because of this coordination of economic policy. And it happens on that natural ground of countries being together. We see 4 priorities for us in terms of keeping the membership together. One, of course, coordinated action in this very difficult time. There will be pain. Working together, we can make this pain less. 2, bringing countries to act on the most profound risks we face. For example, debt distress turning into a debt crisis, undermining potentially financial stability. 3, advocating for open trade. 4, bringing the membership together on climate policies, the macro side of climate policies, how fiscal and monetary policy can support climate action. And I see it is tougher. Because it is tougher, we have to be even more determined to prevent the world to slip into lower standard of living because of fragmentation.
Kristalina, let me just probe you a little further on your last point. So the Russian invasion of Ukraine was clearly an egregious violation of the post-war multilateral order, which has served the world pretty well. And the IMF is also a part of that order. At the same time, the IMF was created to foster cooperation in an environment of political conflict, including political conflict within its own membership. And for that reason, the IMF is, constitutionally required to stay away from politics. So there is a bit of an intrinsic tension here. One feels that in order to defend the international order, the fund cannot quite avoid staying out of politics. On the other hand, neutrality is the premise of the fund. I'm just wondering how has the fund and how do you personally deal with that tension? So how can the fund best defend multilateralism in this very difficult conflict where the membership itself is so split?
The best way the fund can provide that avenue for cooperation is to concentrate on critical issues that matter to the world. And this is why I believe that our role is to build bridges for our members on the key economic topics. And I actually outlined them in what I said before. what are the critical policy challenges where learning from each other and cooperating, we can get to a better outcome. Let's remember that we are talking about a tough time this year, but next year it would be tougher. We do have to be honest with people that there are tough times ahead, but that we can make that pain less, and we can have a strategy of how to take advantage of a crisis as an opportunity. Let me give you one example. For Europe, this winter, and actually even more so next winter, are going to be difficult. I pray that Mother Nature is compassionate and that the winters are milder this year and especially next year. But it is also a signal that something that we know we have to do, accelerate the green transition, it has to happen. So Europe has a chance to put on steroids both technological developments for reducing emissions and economic incentives for a much faster move. In parentheses, we published a paper around the fiscal policies of the EU, and one of the recommendations in this paper is for EU to create a EU climate investment fund, so there can be a very rapid, accelerated move. Just to give you one example, you're in Brussels, you go around, you see solar panels in Belgium. Not the sunniest country in Europe. Why should there be any roof without a solar panel in the sunnier part of Europe? But there are still plenty of roofs there. So we look at this from the perspective of what can be done that would be positive for the economy, even if it is driven by a short-term pain. We see the fund being very important in conversations on trade. And I can tell you that our relations with the World Trade Organization are even stronger. How can we get the membership to be more attuned to the risks short-term benefit of trade restrictions can create for their economies? You know the topic of debt. We're struggling, but we have finally a shining example of Zambia on the common framework. How can we get the world to a point when a debt resolution is possible? And by the way, as you know very well, China was critical in this case, and China acted constructively. So building a portfolio of examples of how cooperation practically helps. This is the way I want us to go, especially in an area like cross-border payments. Where we need to anticipate digital money coming, can we build a monetary system for the future that is not fragmented despite all of these tensions we face today? And that means that we act where we have expertise within a political environment that it is what it is.
Wonderful. We have a few minutes left for some questions from the audience. And so if you would like to ask a question, I think then there would be some microphones. I don't know whether yeah, so there's a lady there. And we will collect a few questions.
Thank you very much. Heather Graby from Open Society Foundations. Thank you very much for laying out so many very interesting points about the situation at the moment. One of the key instruments that everyone always calls on from the IMF whenever there's a crisis or any kind of additional need is SDRs. So Ukraine happens. Let's have some more SDRs. Climate change. Let's do some more SDRs. It's a thing that always is drawn on. And yet this is a legacy of a very different kind of economic system, both in terms of the distribution of SDRs and also what they're used for. What do you see as the future? Will they still be the weapon of last resort of the IMF in 20 years' time, or has their time come already?
Thank you. If you don't mind, let's try to collect 2 or 3 questions and then move to then have you reply in the end. So I think good Geisert. Thank you, Heather, for the great question. And a third, I can take one more question. If there's a third question, please raise your hand.
Kurt Geisert, I'm one of the guys in the House of European History. You said for bringing down inflation, there is a big role of single states. What is, in your eyes, the role of the Euro group with its 19 members?
Thank you. And a third question here in front.
Thank you. This is Can Ercan from Turkish delegation to the EU. You underlined the importance of new supply routes or supply regions, and you underlined also the importance of Africa. But you also mentioned that there are some uncertainties. So would you elaborate on that? What do you see in terms of uncertainties for Africa? Thank you.
Okay, please.
So great questions. SDRs. You asked me about SDRs and you tell me we have only a couple of minutes left. I'm in trouble. First, the facts. We have had 2 significant SDR allocations at the time of crisis or after a crisis, 250 billion after the global financial crisis and 650 billion last year. They were both successful. The 650 billion allocation was independently assessed by a think tank in the United States, and it has shown that it has provided vital support, especially to low-income countries. We are now working on lending of SDRs. We want to amplify this support. But this on-lending, by the way, we have already 73 billion pledged, and we continue to work towards 100 billion goal. This on-lending is a symptom of a problem we have, that SDR allocation done as a general allocation provides reserves to countries that need it and to countries that don't need it. And then we go through this new innovation of on-lending from one group, those who don't need it, to another group, those who need it. A much simpler way would be if there was to be only a selective capital increase, SDR allocation that would go for the reserves of countries that need it. So if you ask me, should there be a further evolution of SDRs? My answer is yes, we should reflect, and potentially with 85% of our membership, we could go in a direction in which in the future there are selective SDR allocations based on addressing of what exactly is a problem at that time. I personally believe that SDRs would remain in the toolbox of the world because they have proven to be useful. And I am hopeful that in the next years, there would be more thinking around how to make it even more useful, how to modernize also the deployment of SDRs once they are allocated to countries. Right now, first thing first, right now, our priority is to make the on-lending work. And we are making excellent progress. Comes October, the IMF will experience a small revolution in our premises, which is the creation of the Resilience and Sustainability Trust that is to support structural transformation on a longer-term basis with an instrument with 20 years a maturity and 10.5 years grace period, something we have not had, especially helpful for the climate transition. And I'm also thinking at some point we have to come up with a name that rolls in the mouth much easier than special drawing rights. But that is for the future. On the question of the Eurogroup, it is, in my humble opinion, and I need to admit I'm biased as a European. I care very deeply about Europe. The Eurogroup has done something. The creation of the euro was a great decision in bringing smaller and larger economies together, so they can use their collective strength to support the currency that has so far over the years served the Europe well. But your question is a very good one. What does it mean when inflation is different in different countries? What can the ECB do? How can the Eurozone operate in this environment when different countries, in fact, do require moderation of monetary policy, different application of monetary policy? And the answer to that is, to a smaller part of the answer is what has been created with the transmission protection instrument. It does provide more stability should there be more pressure in one place than another, and risks associated with it. And it is ex ante unlimited. So that is a very, very strong statement of purpose. But also the fact that there are other complementary instruments, especially in fiscal policy, that can moderate what monetary policy is doing on the basis of the Eurozone. I think my personal view is that we have seen ECB over time to come with innovations, to come with solutions to problems, anticipate and further develop. And it is, after all, a place where all central banks of the Eurozone countries come together. On the third question on the uncertainty around new supply routes, let me first say that broadly there is huge uncertainty, and it is driven by three factors. We don't know how the Russian war on Ukraine will evolve and end, and I personally would love to see it over. I would have loved to see it over on the 24th. I would have loved to not see it start. Obviously, but the uncertainty it brings is quite significant. Secondly, the course of monetary policy in countries and how that would evolve. There is a great deal of uncertainty around it. And three, we just don't know what is the next shock to hit. My main message to everybody is we live in a more shock-prone world, and that requires much more agility in policy, and actually does require much more international cooperation. Ironically, we risk to have less of it.
No? Okay.
With regard to,
right.
let me stop there.
Kristalina, thank you so much for your great contribution and for being here with us. It was really an honor for us, and I think I speak also in the name of Jeromin. We're really grateful that you made it this morning and that you were so open and clear on many difficult questions that we asked you. So thank you so much, and please join me in thanking the Managing Director.
Thank you. Thank you.